You're 65. You did the hard part already. You saved diligently for 40 years, and somehow you actually ended up with a real number in your traditional IRA, not a token amount, $1.5 million. You should feel relieved. Instead, you're sitting across from a financial advisor who just said something that made your stomach drop. That giant pile of money you built is, in a very real sense, only partly yours. The IRS still has a claim on a huge chunk of it, and depending on how you handle the next 10 years, that claim could cost you somewhere between $290,000 or close to $500,000. Same exact pile of money, a difference of roughly $175,000, just based on how you move it. Here's the thing. Most people have never even heard of the strategy that creates that gap, and the ones who have heard of it usually only know it by one word. A caller on Dave Ramsey's show recently brought up exactly this dilemma, and Ramsey's answer hinged on a single, almost playful word that perfectly captures the entire strategy. He called it dribbling the money out instead of dumping it all at once. And honestly, once you understand the mechanics behind that one word, you're going to look at your own retirement account completely differently. So today we're going to break this down properly. What a Roth conversion actually is, why doing it all at once can quietly hand the IRS a 5-figure bonus you never had to give them, the exact math behind why spreading it out saves so much, and the one variable that actually determines whether any of this even applies to you. By the end of this video, you're going to understand a piece of retirement tax strategy that most financial advisors mention once and never fully explain. Hello, I'm Anne. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Let's start with a basic mechanic, because if you've never dealt with a Roth conversion before, the concept is simpler than it sounds. A traditional IRA is money you saved tax-deferred. You never paid income tax on it going in, but you will pay tax on it eventually, whenever you withdraw it. A Roth IRA flips that completely. You pay the tax up front, on the way in, and then that money grows and comes out completely tax-free for the rest of your life, and often for your heirs, too. Converting a traditional IRA to a Roth means voluntarily paying that tax bill now, on your terms, instead of later, on the government's terms. The question isn't whether you'll eventually pay tax on that money. You will, one way or another. The question is when and how much. And that's where this entire strategy lives. Here's why the timing question matters so much, and this is the part that should genuinely change how you think about your own retirement account. The U.S. tax code is progressive, which means every additional dollar of income you generate stacks directly on top of whatever income you already have and gets taxed at the next bracket up from there. Think of your income like pouring liquid into a glass with marked lines on it. The first few ounces fill the bottom of the glass at the lowest rate. But the moment you pour in more than the glass can hold at that level, the overflow spills into the next section, taxed at a higher rate. Pour in enough at once, and you can blow straight through every single line on that glass in one shot, paying the absolute highest rate on a huge chunk of money that didn't need to be taxed that aggressively. That's exactly what happens if you convert a $1.2 million IRA in one single year. Stacked on top of whatever other income you already have, that conversion barrels through bracket after bracket and parks a meaningful slice of your money at the top marginal rate. Spread that same conversion out, say $100,000 a year for 12 years instead, and you can stay almost entirely inside the cheaper brackets the whole time, never spilling over into the expensive section of the glass at all. Now let's put real numbers on this, because vague tax bracket talk doesn't hit nearly as hard as actual dollar figures. Under the current federal brackets for married couples filing jointly, the 12% bracket covers income up to roughly $100,800. The 22% bracket runs from there up to about $211,400. The 24% bracket extends to around $403,550. Then 32% takes over, up to roughly $512,450, followed by 35% up to about $768,700, where the top 37% bracket finally begins. The standard deduction sits around $32,200. Those numbers matter because they define exactly where the spill line sits on that glass we just talked about. Let's run an actual scenario, because this is where the strategy stops being theoretical and starts being something you can picture yourself doing. Take a couple, both 65, with $1.5 million combined in traditional IRAs. That's a meaningful sum, roughly 6 times the average baby boomer's IRA balance, which sits around $257,000. But it's a completely realistic outcome for someone who saved diligently for decades. This couple draws about $80,000 a year combined from Social Security and a small pension. After the standard deduction, their taxable income sits around $48,000, comfortably inside that cheap 12% bracket. Now they're deciding how to handle converting that $1.5 million. Option 1, the dump. Convert the entire amount in a single year. Stacked on top of their existing income, that conversion blows straight through the 22%, 24%, 32% and 35% brackets, with the top slice landing at the full 37% rate. The federal tax bill on that single conversion lands somewhere around $475,000 to $500,000, and that's before state tax, and before a separate, often overlooked Medicare premium surcharge called IRMAA that triggers automatically once your income crosses certain thresholds. Option 2, the dribble. Instead, convert roughly $150,000 a year for 10 years. Each year, that conversion fills up the remainder of the 12% bracket, most of the 22% bracket, and only a small slice spills into the 24% bracket. The blended federal rate on each year's conversion lands somewhere around 18% to 20%. Over that full decade, the total federal tax on the exact same $1.5 million comes in around $290,000 to $310,000. Sit with that gap for a second. Roughly $175,000 in federal tax saved. Same starting balance, same ending Roth account, same family, same decade. The only difference is the pace at which the money moved from one account to the other. And here's the bonus on top of that savings. Once that money is sitting in the Roth, it grows completely tax-free for the rest of this couple's lives and for their heirs during whatever window applies to inherited Roth accounts after that. Okay, so by now you might be thinking this sounds like a strategy everyone with a large IRA should just blindly follow. And here's the twist. That's not quite right, and understanding why is actually the most important part of this entire video. The whole strategy hinges on one single variable: what your marginal tax rate will actually be in your 70s compared to what it is right now. If you're going to be in a lower bracket later, say because your income naturally drops once you stop working and before other income sources kick in, converting now and paying tax at today's rate could actually cost you more than just waiting and paying tax later at a lower rate. But if you're going to land in a higher bracket later, converting now while you're in a cheaper bracket saves you real money. The entire decision is a bet on your own future income trajectory, and getting that bet wrong in either direction costs you. So here's the reveal that catches a lot of retirees completely off guard. Required minimum distributions, or RMDs, kick in starting at age 73, and they're not optional. The government forces you to start withdrawing and paying tax on a percentage of your traditional IRA every year, whether you need the money or not. On a $1.5 million traditional balance that's kept compounding through your 60s, that first year RMD often lands somewhere near $60,000, and it only grows larger from there as the account keeps compounding and the required withdrawal percentage increases with age. Layer that RMD on top of Social Security, a pension, and any other portfolio income, and a couple who was comfortably sitting in the 12% bracket at 65 can easily find themselves pushed into the 24% or even 32% bracket by 75. That rising tide of forced income is exactly the bracket creep Ramsey was warning his caller about, and it's the entire reason the dribble strategy exists in the first place. You're not avoiding the tax. You're choosing to pay a smaller portion of it now, voluntarily on your own schedule, instead of a larger portion of it later, forced on the government's schedule. There's also a return on money angle worth understanding here. With longer-term interest rates sitting notably elevated, the 10-year Treasury recently near a 12-month high around 4.6%, alongside a Fed funds rate with an upper bound around 3.75%. Every dollar you move into a Roth today compounds tax-free against a genuinely attractive real yield backdrop. In other words, the environment for letting tax-free growth work in your favor over the coming decade isn't just theoretically nice, it's mathematically meaningful, given where rates currently sit. Let's pause and knock out a myth here, because I guarantee it's rattling around in some of your heads right now. Wait, if I convert and pay tax now, aren't I just paying tax I wouldn't have had to pay otherwise? It's a fair question, and the answer is genuinely counterintuitive the first time you hear it. You were always going to pay tax on that traditional IRA money eventually. There's no version of this story where that money comes out completely untaxed if you leave it in a traditional account. The only real choice is when you pay and at what rate. So the goal of a conversion strategy was never to avoid taxation altogether. It's to control the timing, so you're paying tax while you're standing in a cheap section of that glass we talked about earlier, instead of being forced to pay it later by RMD rules, while bracket creep has shoved you into a much more expensive section. Converting isn't creating a new tax bill out of thin air. It's choosing which version of an unavoidable bill you'd rather pay. There's a second myth worth knocking out too, and this one's about who this strategy is actually for. A lot of people hear Roth conversion strategy and assume it's a tool exclusively for the ultra-wealthy, the kind of move reserved for someone with a financial advisor on speed dial and 8 figures in assets. But look back at the numbers in our scenario. A couple with $1.5 million combined, drawing ordinary Social Security and a modest pension. That's not generational wealth. That's the outcome of a few decades of consistent, disciplined saving by an ordinary working couple. If you've built any meaningful traditional retirement balance at all, this conversation applies to you, not just to people featured in financial magazines. Now let's also talk about why the heirs piece of this matters more than most people realize. Because it's easy to focus entirely on your own tax bill and forget that this decision outlives you. If your children eventually inherit a traditional IRA from you, they generally have to withdraw the entire balance within a set number of years after your death. And every dollar they pull out gets taxed as their own ordinary income, often during their own peak earning years, when their tax bracket might be higher than yours ever was. Compare that to inheriting a Roth IRA, where that same withdrawal window still applies, but the money comes out completely tax-free the entire time. You're not just optimizing your own lifetime tax bill with this strategy. You're potentially handing your kids a tax-free inheritance instead of a delayed tax bill with your name quietly attached to it. Now let's turn this into something you can actually act on this week, because understanding the mechanics is only useful if you actually apply them to your own numbers. First, pull up last year's tax return and figure out exactly which federal bracket you're currently sitting in and how much room you have left before you'd spill into the next one up. That single number is your starting point for everything else in this strategy. Second, project what your income looks like once RMDs actually start. Estimate roughly what your traditional balance will be at 73. Multiply that by approximately 4% to estimate your first required withdrawal, and then add in Social Security and any pension income on top of that. That projected number tells you whether bracket creep is actually coming for you, or whether your income is more likely to stay flat or even drop. Third, pick a target ceiling for your conversions based on what you find. Ramsey's instinct here is exactly right for most retirees. Aim to bump yourself up a bracket or two through deliberate conversions, but generally avoid pushing all the way into the 32%, 35%, or 37% territory unless your specific numbers genuinely justify it. Fourth, keep a close eye on what are sometimes called IRMAA cliffs, specific income thresholds that automatically trigger higher Medicare premium surcharges. These thresholds aren't gradual. Crossing one by even a single dollar can add real money to your annual Medicare costs. So any conversion plan needs to account for exactly where those lines sit, not just where the regular tax brackets sit. And fifth, think carefully about timing your conversions relative to when you actually start claiming Social Security. Converting income before you begin claiming benefits can help you avoid making a larger share of those future Social Security payments taxable, which is its own quiet form of bracket creep that often gets overlooked entirely. Before we wrap up, I want to mention one more thing because it ties directly into everything we just covered about disciplined, long-term financial habits. There's a well-documented pattern in behavioral finance research. People who automate their savings and contributions, setting up the transfer once and then simply leaving it alone, consistently end up with dramatically larger account balances than people who rely on manually deciding to save each month. It has nothing to do with earning more, clipping coupons, or white-knuckling your way through extreme frugality. It's almost entirely about removing the decision from your own hands, so inertia works in your favor instead of against it. The same principle applies beautifully to a multi-year Roth conversion strategy. Set your annual conversion target based on your bracket math, automate it as much as your custodian allows, and let the plan run itself instead of redeciding and second-guessing yourself every single year. Here's my honest take, and I say this because I think this exact strategy gets buried under far too much financial jargon for how genuinely useful it is. A six-figure difference in lifetime tax isn't some obscure marginal optimization. It's potentially one of the largest single financial decisions a retiree with a substantial IRA will ever make, and it's almost entirely within your control. You don't need a market-beating investment strategy to capture this gap. You don't need to take on any additional risk. You just need to understand where your bracket lines sit and have the discipline to dribble the conversion out instead of dumping it all at once out of impatience or a desire to just get it over with. So here's what I want you to do this week. If you've got a meaningful traditional IRA balance and you're anywhere near retirement, pull your last tax return and actually find your current bracket. Run a rough projection of what your RMD era income could look like. And if the numbers suggest bracket creep is coming for you, sit down with a tax professional or financial planner, not to hand the decision off entirely, but to confirm your own math before you commit to a multi-year conversion plan. Because the difference between handling this well and handling it carelessly isn't measured in dollars and cents. It's measured in tens of thousands of dollars, sometimes hundreds of thousands, quietly staying in your family's hands instead of leaving through the door marked IRS, simply because you understood one word, dribble, a little better than most people ever bother to. And if there's one image I want you to carry away from this entire video, let it be that faucet. Not a dam holding everything back, and not an open floodgate dumping it all out at once. Just a steady, deliberate faucet, running at a pace you control, year after year until the job is done. That's the entire strategy, distilled into something you can actually picture the next time you're staring at your own account balance, wondering what to do with it. If this video helped you see your own retirement account a little differently, share it with someone who's sitting on a large IRA and has never heard this strategy explained clearly. And if you want more breakdowns of the retirement tax moves that quietly separate people who keep more of what they saved from people who hand too much of it away, make sure you're subscribed because there's plenty more of this conversation still ahead. Your future tax bill is one of the few financial outcomes you actually get years of advance notice on, which means the only real mistake here is knowing all of this and still doing nothing with it.